If you guys are taking passive investors, you're most likely selling a security. You can avoid the extra tax return for the extra LLC, somewhere between $5,000 and $10,000, maybe even more, maybe $12,000 to $13,000 for the syndication portion. And you can form a small LLC. Everybody's a manager in the LLC, and you go take down the asset. If you're in Texas, and I would say 60% of you are in Texas, and your assets in Texas, you should be incorporating in Texas. That is not legal. That is illegal. That is paying somebody to bring in capital, and the only people you can pay to bring in capital are broker-dealers. It's not a slap on the wrist. It's a punch in the face about 400 times. The other reason single-purpose entities or funds are so popular, less experienced sponsors can jump right into them. People are getting deals at 15 to 20% below value right now. A blind fund doesn't have to be one asset. I've done a blind fund with 300 single-family properties. We bought them one at a time.
How long can capital sit before using it?
Capital doesn't get stale, but the owner of the capital gets very stale. There are more people doing blind funds in the last 6 months than we've probably had collectively in the last 5 years.
Are multifamily syndications an example of single asset fund?
I would say yes, 100%.
But bottom line, you buy a property, you sell it for a profit. You don't want to take the profit and pay the taxes right now. So you enter into a 1031 exchange. Half of our clients have done very, very well on TICs. Takes the right personalities to work with each other and takes the right experience. More deals are done in October, November, and December with larger capital amounts than any other deal because people are trying to take advantage of the depreciation expense. Here's something no one does. Blows me away. Nobody does background checks on their co-sponsors. Other force majeure provisions that we've drafted in is if it lasts more than 30 or 45 days, the purchaser has the option to terminate the contract. And here's the kicker, we're pushing for a full refund of earnest money. This one's fun. And by the way, in the outline, I've got an outline, I've got a split screen. In the outline, you're gonna see a lot more information. I actually go through a chart, the difference between a Reg D, 506B, a Reg C, crowdfunding, and there are two other types of potential ways to raise capital that are exemptions that a lot of you aren't taught because you're part of different types of investor groups. But there are several different ways. So again, I highly recommend you guys download when Roxy sent it to you. We have seen a lot more 506Cs in the last 2.5 months than we have probably in the last 2 years collectively. We're doing more blue sky filings, I think, than we've ever done before. The blue sky filing is when you're taking an investor who's outside of your state. We're in Texas, and if I take an Oklahoma investor, we have to register with Oklahoma's Board of Securities. That's a blue sky filing. One thing that actually might help some people on the call, to the extent you have an employee in your fund that's part of your management team, or maybe even not part of management, but under management, that wants to invest and that has substantial knowledge as to the fund, that employee can qualify as an accredited investor. If you're doing a 506C, which is the best way to verify someone's accredited status? I take the path of least resistance. You would use a company like Verify Investor. The first one is an acquisition fee. Some clubs allow it, some clubs don't. Typically what we see on an acquisition fee is anywhere from 1% to 3% if we see an acquisition fee. So they're buying this asset for 3.9%. It's costing them 3.9% a year to buy the asset. That's unbelievable. The 5 types of debt that you're gonna see are agency debt, which are your Fannie Freddie backed loans, CMBS. You're creating either a second tier of debt that's been approved by the investor. Waterfall provisions, bottom line, they can be as simple as the manager gets 20% and the members get 80%. Know your exit strategies before you even buy into the fund. Before you buy the asset as a syndicator, have 2 or 3 different exit strategies. As long as interest rates are low, it always creates opportunity for us. But guys and gals, now is the opportunity to go out and do deals when you see good deals, and you can structure some very interesting deals. There are more investors getting into real estate now on the passive side than we have seen.